Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world one filing at a time. Today, we're diving into the Swiss Helvetia Fund's annual report, and let me tell you, there's a twist in the tale involving a change of strategy that's about to turn this Swiss watch inside out, or should I say, yodel it upside down. Let's begin by understanding what's been happening with how the fund pays out money to its shareholders. They had this system called a managed distribution policy. Basically, they were aiming to give out a fixed amount every quarter, like clockwork, or rather, Swiss clockwork. It started at about $0.129 per share. Then in December, they bumped it up a bit to around $0.1458 per share. However, don't get too comfy with these numbers because the important part is that this policy could change any time the board feels like it. What you got last time might not be what you get next time. So how did the fund actually do? Well, the report tells us that the fund's net asset value, its NAV, went down about 3.09% in the last year. The share price also took a hit, decreasing about 2.49%. Compare that to the Swiss Performance Index, or SBI, which also decreased but only about 1.55%. So the fund didn't exactly beat the market, it actually underperformed a little bit. Now, what was going on in the world that might have caused this? Globally speaking, 2024 was a year of modest growth where interest rates started coming down. The US Federal Reserve kept rates high for a while, causing some investor jitters. Then, a little later in the year, the election of Donald Trump seemed to boost some optimism, but also raised fears that interest rates might go back up due to potentially inflationary policies. In Europe, they were cutting rates too, but still struggling with some economic problems. Overall, the global stock market, as measured by the MSCI World Index, increased over 19%. The investment team says that the style of investing that favors value, which means buying stocks that seem cheap relative to their actual worth, did better than growth, or buying stocks of companies expected to grow quickly. Also, the fund's focus on smaller and mid-sized companies didn't help as much, since these stocks didn't do as well as the big ones. Some of their stock picks did pay off, like Galderma and Swissquote. But other choices like N-CSR and Swatch didn't work out so well. During the year, the fund completely sold off its shares of Forbo, Idorsia, and Software One. Looking ahead, the fund's portfolio managers are expecting continued global economic growth, but they're also watching out for a few things that could go wrong, especially what might happen now that Donald Trump is president. Also, since about 27% of the companies they invest in get their revenue from the US, any new trade duties could be a problem. Finally, a really strong Swiss franc might hurt exports. The Swiss National Bank says that the exchange rate has remained relatively stable, which leads them to think that Swiss companies will remain competitive. Alright, let's take a look at the hard numbers. The average annual total returns for the fund, the net asset value return was negative 3.09% for the year. That's what we saw earlier. Over the last 5 years, it's been a little better, 4.28% on average. And over the last 10 years, 5.71%. Let's take a look at what they are holding, their investments. You'll find that most of their money is in common stocks. About 24% of the fund's money is in pharmaceuticals, then 14.5% is in food companies. A little less than 10% is invested in insurance companies. Names you might recognize are Nestle, Novartis, and Roche. Scrolling down some more, healthcare is next. The fund held 24,000 shares of Alcon AG. Alright, let's check out the statement of assets and liabilities. Total net assets are about $116 million. That breaks down to about $8.94 per share. Looking at their expenses, investment advisory fees are the biggest chunk at about $878,000. They pay their directors about $308,000. There's legal and audit fees, and then a lot of other smaller expenses. Now, for the year, they made a little over $3 million in income from dividends and interest. After paying expenses, that leaves them with a little over $1.3 million in net investment income. But when you factor in realized and unrealized losses on their investments and currency stuff, they actually ended up with a net decrease in net assets from operations. The statement of cash flows tells us that they ended the year with about $2 million in cash. What about buying back their own shares? Turns out they didn't buy any back during the year, although the board authorized them to. The fund is authorized to issue up to 50 million shares of capital stock. The fund has a capital commitment to Aravis Biotech II Limited Partnership. The original capital commitment was about $3.5 million, but they've already put all the money in as of the end of the year. The report from their independent auditor, Tate Weller and Baker LLP, says everything looks good, that is, the financial statements are presented fairly. Here's the deal: if you want to know how the fund votes on things like electing directors or big company decisions, you can find that information for free on the SEC's website. Here is the listing of all the directors. We find Andrew Dacos here. Let's skip the addresses since we are not gonna send anyone letters. The automatic dividend reinvestment plan says that if you own shares, you can automatically use the dividends you get to buy more shares. It is totally optional and can be stopped at any time. Okay, so let's sum it all up. The fund is managed by Schroeder Investment Management North America Inc., with a team of Stefan Frischknecht and Daniel Lentz calling the shots day to day. You can find the value of the fund's assets published weekly at many major financial publications, such as the Wall Street Journal. Now here is the twist. As we get to the very end of this report, there is a note about something big that happened in February of this year. Stockholders voted to change the fund's investment goals and to change the investment managers. The new goal, not just capital appreciation but long-term total return. They are also planning to sell off most of the investments and give a big chunk of cash, about 30% of their assets, back to the shareholders. What was once an investment primarily in Swiss equities will no longer be the case. So, what does this all mean? Well, it looks like the fund is heading in a completely new direction. Instead of sticking with Swiss stocks, they're opening the door to all sorts of new investments with a new manager. I'd say that the biggest risk to them is the execution of this new investment strategy. But on the flip side, this change could be a huge opportunity if the new strategy and investment team can deliver better returns. Thanks for watching. If you found this useful, please subscribe, like, and comment.